Estimated tax is just pay-as-you-go for people without enough withholding. Think self-employment, gigs, investment income, or a big one-time gain. You're trying to avoid an underpayment penalty by paying during the year, not all at filing time. On the EA exam, they love asking who needs estimates. If withholding won't cover it, estimated payments usually step in. For most individuals, estimated taxes follow a 4-payment schedule. First is April 15th, second, June 15th, third, September 15th, and the fourth is January 15th of the following year. If a due date lands on a weekend or legal holiday, it bumps to the next business day. If you mail a check, the postmark date counts as the payment date. That's the mailbox rule concept you need. Don't forget the weird one. The fourth estimated payment is due January 15th next year, and timing rules differ by method. Mailed payments use the U.S. postmark date. E-filed returns get an electronic postmark. But the EA exam may test that not every electronic submission gets mailbox rule protection, especially time-sensitive documents sent by fax, email, or portal uploads. Farmers and fishermen get a special break if at least 2/3 of gross income is from farming or fishing in the current or prior year. Instead of 4 estimates, they can avoid quarterly payments by filing and paying the full balance by March 1st. If they can't file by March 1st, they can make one required annual payment by January 15th. This exception shows up a lot on exams because it's so specific. Now the safe harbors. You generally avoid the underpayment penalty if you paid enough during the year through withholding and/or estimates. The big ones: pay 90% of current year tax or 100% of prior year tax. If prior year AGI is over $150,000, 75 towers, near it filing separately, swap that 100% for 110%. Also, if you'll owe less than $1,000 after withholding and credits, no penalty. One of the best exam traps is the 0 prior year liability rule. If a U.S. citizen or resident had 0 tax liability last year, they're typically not subject to an underpayment penalty this year, even if they owe a lot, so long as they file and pay by the unextended due date. Separate from that, you can often fix underpayment issues by adjusting withholding using Form W-4 or W-4V for Social Security withholding. When the IRS does assess an underpayment penalty, Form 2210 is the tool to calculate it, and sometimes to request a waiver. And don't confuse estimated tax with backup withholding. Backup withholding is when the payer withholds because of missing or mismatched taxpayer info, usually a W-9 issue. The rate is a flat 24%. On the EA exam, they'll test that this is payer-driven, not the taxpayer choosing estimates. Mateo has a loss from worthless securities. How many years does he have to amend his tax returns in order to take this loss? The options include 2 years, 7 years, 6 years, or 3 years. Think about what special statute applies to worthless securities refund claims. The correct answer is 7 years. A claim for refund attributable to a loss from worthless securities uses a 7-year period, which is an exception to the normal refund claim statute. 3 years is the tempting choice because it's the common rule, but worthless securities are one of the classic exceptions the EA exam expects you to recognize. Which of the following taxpayers is required to file a return in 2023? You have a married filing separate taxpayer with only interest income, a single taxpayer with wage income near the filing threshold, a dependent child with small interest income, and a taxpayer with wages plus a small amount of self-employment income. Think about the filing status rule that has the lowest threshold. The correct answer is Monica, married filing separately with $1,000 of interest income. Married filing separately generally must file if gross income is at least $5. So $1,000 clearly triggers a filing requirement. A common trap is focusing on the single filing threshold, but MFS has that unusually low filing trigger.